Imagine starting a business, growing it, and selling your stock one day for $10 million without paying a dime in capital gains tax. Sound like fantasy? That's the QSBS exclusion under Section 1202. And thanks to the One Big Beautiful Bill, it just became one of the smartest moves in modern tax planning. Here's what changed. The One Big Beautiful Bill protects and enhances the QSBS exclusion. Section 1202 already allowed certain small business stock sales to qualify for up to 100% capital gains exclusion, but it had limits, confusion, and the threat of phase-outs. One Big Beautiful Bill locks it in, securing a more predictable, usable path for founders, early employees, and investors to sell tax-free when they meet the rules. So what exactly is QSBS? Qualified small business stock is stock issued by a domestic C corporation that meets specific requirements. The corporation's assets must be $50 million or less at the time the stock is issued. It must be engaged in an active trade or business, not just investing or holding assets. The stock must be acquired directly from the company, not on the open market. And you must hold the stock for at least 5 years to qualify for the exclusion. If you meet all of those requirements, you could exclude up to $10 million or even more in gains when you sell. QSBS is one of the most powerful long-term tax strategies for entrepreneurs, early investors, and startups, and most people have never heard of it. The QSBS exclusion has been around since the 90s, but it became especially useful after the 2017 Tax Cuts and Jobs Act, and again under certain temporary pandemic provisions. But the rules were narrow, subject to debate, and weren't permanent. The One Big Beautiful Bill changes that. It confirms the 100% capital gain exclusion for eligible small business stock held at least 5 years, and it ensures that more investors and business owners can plan confidently using Section 1202 without fear of future clawbacks. So who should pay attention to this? Startup founders issuing stock in a C Corp, investors buying into early-stage companies, employees receiving equity in qualified small businesses, business owners considering a C Corp structure for future exit planning, and high-income earners looking for long-term tax-free growth opportunities. If you want to build a business and sell it someday, this is one of the most powerful wealth-building tools in the tax code. Let's break it down. You start a business and you issue yourself QSBS eligible stock. 5 years later, you sell your shares for $5 million in gain. Under Section 1202, that entire $5 million can be excluded from capital gains tax if you qualify. That's up to $1.2 million in tax savings just by using the right structure and holding period. And thanks to One Big Beautiful Bill, this strategy is no longer temporary or uncertain. It's built to last. Here's your strategy move. If you're launching a new business and see long-term growth on the horizon, consider a C Corp election to potentially qualify for Section 1202. But timing and structure matter. QSBS must be issued by a domestic C Corp under $50 million in assets and used in an active trade or business. You have to hold the stock for 5 years and keep detailed records. Work with a pro who understands this, because if you get it right, it can mean millions in tax-free wealth. Glad you could join us. If you're ready for a smarter approach to taxes, check out Taxmithing, our personalized tax strategy process. Reach out to us anytime.